Hello, everybody, and thank you so much for joining in. I am Kavita Agrawal, the founder of EXP Invest, and in today's Detailed Traders special series, we are here to talk about trading mindset. So, touching upon this entire topic of psychology, we are doing a five-part series where every day we will discuss one topic related to trading psychology. So, today, as I would say, the second class, because last week also we talked about trading psychology. So, in today's session, we are going to cover the basics of behavioral finance. Basically, what is behavioral finance? Why did it come through? And how can you use it to become a better trader? More importantly, why is behavioral finance so important for you to know about and to also deploy in your day to day trading? I have some notes that I will be referring to it from time to time. This is going to be around 15 to 20 minutes of discussion, after which I will turn to your question answers. And of course, we'll take a look at charts jointly. So feel free to drop in your stock queries in the comment as I begin. So, behavioral finance. So, by definition, behavioral finance is relatively a much newer field and it has only emerged from the recognition that traditional finance theories don't fully explain the behavior of investors or the financial market. Now, traditional finance has been around for a while now, and for many decades, we've tried to explain the changes in price and the whole economics or the whole science of economics with traditional methods. But after having consistently failed to predict what is happening in the market, humanity on the whole basically decided to take a introspective look at what is happening and where is the mismatch coming from between what is being predicted and what is actually happening. And that mismatch is actually where the whole science of behavioral finance was discovered. Behavioral finance is nothing but the acknowledgement of the fact that humans are capable of making irrational decisions repetitive even despite of having conclusive proof, despite of having evidence that the decision making process, no matter how refined it is, under stress and under pressure, humans have this innate tendency of making irrational decisions. So, this is not something that can be eradicated. This is something that can be managed. This is not something that you can absolutely get rid of like a headache, but it is something that you have to deal with because you have to admit that it's going to keep happening to you. It's more like a migraine. So, some of the key areas of study of behavioral finance includes cognitive biases. I know it's a big word, but I'm going to explain what cognitive biases means. And emotional factors such as mainly fear and greed, because these are the two extremes of the emotions especially when it comes to the whole topic of finance and money, which really kick in. And on these two extreme behaviors, on the spectrum of emotions, on these two extremes, we see the most irrational behaviors come into play when it comes to the topic of money. So let's talk about how behavioral finance firstly contrasts with traditional finance, right? Traditional finance, to begin with, assumes that all the market participants are rational and they don't make decisions based and they make decisions based on perfect decisions. But we know that this assumption is not valid, it is not true, because in the first place, she's talking about information. The speed with which information disperses from the moment that it becomes relevant to the last person for whom the relevance remains. The speed at which that information or the time over which the information spreads out is significant. And because there is a mismatch between who has the information and who doesn't have the information, that obviously creates an edge because the person with more information is in a better position to naturally make better decision versus the person who does not yet have the information. However, you will see that the decision making happens at the same time. For instance, the person with the decision may know that suppose a company is going to announce a groundbreaking research. Say a pharmaceutical company is going to announce a groundbreaking new drug. So this first person may be very ready to purchase more and more of the stock of this company. Whereas the other person may be looking at the books and thinking, what? This company hasn't come up with anything new in a long while. and the stock has been in consolidation, I might as well sell the stock and buy somewhere else where he, for instance, may have better information available. The very false assumption of traditional finance that everybody is making decisions rationally or with perfect amount of information is very superficial or is too perfect to be true. The field of behavioral finance basically explores the psychological and the emotional factors in addition to these factual shortcomings of, you can say, the traditional finance. And these psychological and emotional factors have been seen to influence financial decision making significantly. The whole point of understanding these biases, cognitive biases might sound a little complicated, but I'm sure you've heard the term biases before. The whole objective of studying about them and knowing about them is, is that by knowing them, you can have a chance at making better decisions. Behavioral finance basically recognizes that investors are not always rational and emotional, and they are emotional beings, and the biases in this field has been increasing significantly, especially with the advent of technology. That is also one reason why it is even more important in today's time to know about these behavioral finances. So it's actually very recent. The whole concept of behavioral finance came around in the 1970s when two psychologists, there seems to be a bit of an issue with my voice. So basically, in the world of traditional finance, the whole study is based on the fact that, or rather on the assumption that all human beings are rational and all decisions are made based on perfect amount of information. Whereas in truth, the reality is that the information on the basis of which you need to make decisions, the whole process of the information becoming relevant to the point of its disbursement to reach the last person for whom it keeps relevance. There is a huge lag between that. And within this lag, because there are people at every stage of this information disbursement process, the person who gets to know the information a lot sooner has a huge edge. But because the person who's getting to know the information first and the person getting to know the information last, maybe making the decision in the same stock at the same time, there is obviously of imperfection. And this imperfection in the world of finance, which may happen because of these logistical matters like information, or which may happen because of irrational interpretation or irrational behavior caused by extreme emotions like fear and greed. All of these topics come under the topic of behavioral finance. And behavioral finance is a very recent science. Only in the 1970s, two psychologists by the name of, I'll tell you that name. I think one is called Tversky, Mr. Daniel Kahneman, and Amos Tversky. So these are the two psychologists who in the 70s actually wrote a paper on this whole field of behavioral finance, and then it really took off. It was their work was considered naturally groundbreaking in the study of finance and economics. And today, behavioral finance has actually become a very mainstream science and is also part of very important stock market designations like the CMT and the CFA. So let's talk about some of the most common biases which actually affect trading in the stock market. Now, of course, in behavioral finance, tens of twenties of biases have been covered. But when it comes to trading and investing, I have identified three specific biases that you must absolutely know about. And not just know about, you need to actively work on identifying whether you are subject to them and when they get triggered for you. And lastly, how can you deal with it? Now, because just as in the topic of psychology, even behavioral finance, just as in the topic of psychology, because every case is different and every problem is different. So naturally, every solution is different. Same way, even in behavioral finances, even if the category of a bias may be same, but the identification, the trigger, and the remedy for each bias can be different for different individuals. So the first bias that we'll be covering today is the overconfidence bias. What is the overconfidence bias? Basically, how overconfidence leads to an investor overestimating their knowledge and underestimating the risk and overtrading, which ultimately gives them suboptimal performance. So, for instance, just Couple days back, I came across a prospect who told one of my associates that, you know what? I am a swing trader for a very long time and I find swing trading very interesting, but I will never use a stop loss. So my associate asked him, why would you not use a stop loss? So he said that what I have seen is that stock market always goes up. So I am not going to use a stop loss. I'm not going to incur any losses. And ultimately, when the stock goes up, I'm going to still sell. I said it with such amazing confidence that it really got me thinking how he is very comfortable with not thinking about other aspects like the time value of money. Because obviously, if he continues to hold on to a stock, which is currently a loser, no matter how good the company is, he is still incurring a huge opportunity cost. He has no consideration for the risk because ultimately there's no guarantee in the market. So even stocks like Yes Bank, PNB, Unitech, Satyam, they've all seen massive value erosion. Future retails, they've all seen massive value erosion. And to say that overconfidence bias is something that has also affected me. But sometimes it can also happen that overconfidence bias can combine with other biases like anchoring bias, for instance, and it can really make things difficult for you because even if you say that you're being overconfident, you might stay anchored to some initial piece of information which you had come across, which forces you not to change your view about something. Right? So, how do you deal with overconfidence? So, the first thing is how do you identify overconfidence? Overconfidence bias is best identified by education. Basically, when you know better, when you learn more, or when you expose yourself to different knowledge from to different lectures by experts who know probably more than you or who are in a better or a more advanced stage of, say, trading and investing than yourself. So, the first way to deal with overconfidence bias is approach things in a more objective manner and study them firstly with an intellectual curiosity rather than with the objective of just making money. And I'm saying this very specifically for the purpose of trading and investing. So when you do that, when you approach something from an intellectual angle, the overconfidence bias naturally dissipates over time. One good way of dealing with this is suppose you are interested in swing trading. So there are books out there on swing trading. If you're not an avid reader like me, you can also opt for audiobooks. Simply let it play when you're walking to your work or when you're driving or during the day. Even when you're working, you can have the audiobook playing. But usually that doesn't work well because you also need some level of focus on the book if you want to understand it. But that's one way of exposing yourself to new knowledge every single day. You can listen to podcasts, meaningful, knowledgeable podcasts. For example, if you're a student of the CMT designation, then you will get access to the CMT Association's podcast called Fill the Gap. Now, there, very well established technical analysts invite other technical analysts to come and talk about technical analysis. And personally, for me, it's one of my favorite podcasts. Again, it's called Fill the Gap by David Langren. So you should try and listen to that if you can. So overconfidence bias, again, can be dealt by making sure that you continuously educate yourself in the field that you want to participate in. So you may be a long-term investor, but remember that swing trading is a very different ball game and you need a very different mindset, very different habits, very different execution style. And if you are somebody who's not done swing trading before, then the best approach for you would be to get associated with an expert who has a forte in swing trading. Moving on to the next most common bias seen in trading and investing, herd mentality. The herd mentality is very commonly observed during market bottoms and market peaks. Because what happens during market bottoms? Nobody wants to buy. What happens during market? Nobody wants to sell. But what should you have done? Exactly the opposite of that. Why didn't you do it? Because nobody else was doing it. I'll give you one other example of herd mentality that I personally came across, and that is not related to the stock market, but I'll just give you the example. So in my society, in my complex, we moved in very recently, and so did the others because it's a very new complex. And to our surprise, the management of the complex, which I'm sure a lot of other people might have also experienced this, despite of having guarantee that we wouldn't have to pay any additional maintenance, started suddenly asking first they are something to the tunes of 3 to 4 thousand maintenance every single month. Now, once it started happening, that first there was outrage. Everybody was very angry because we were given long bills after accumulation after 8, 9 months. But what happened started happening was one person paid it. And because one person went ahead and paid it, he started advocating to others that you can't do anything, you can't go fight with the builders, might as well pay it. So other people also started paying it. So now whoever comes in new and gets to know about this discovery that suddenly there is a huge charge that needs to be paid on a monthly basis, the first reaction is they get angry. The second reaction is they talk to their neighbors. The third reaction is that if everybody is paying, I guess I'm going to have to pay because I can't fight alone. So this is a very typical example of herd mentality. And this herd mentality also happens in the market because when the market is crashing, or you call it crashing, when the market is simply correcting or it's taking a breather, you go to the TV and you see the TV analyst talking about if the market is at 20,000, 19,000, if the market is at 19,000, 18,000, if it's at 18,000, 17,000, sometimes they even go as down as 7,000. Right? You talk to your colleagues and you hear people saying that I sold, I was very smart, I sold all my holdings at the top. So now all you're hearing about is I should have sold, I should have sold, I should have sold. They're going to be lower levels, they're going to be lower levels. So you get into that mentality automatically. The best way to break away from herd mentality is approach your trading and investing decisions objectively. So if you've dealt with your overconfidence, if you've done the groundwork that you've studied, then apply what you have studied. Make your own observations or listen to what your analyst is saying. Now, for instance, in my own Trade Together program, where I give swing trading recommendations to my members, when I started giving recommendations in the early November, there was a lot of skepticism. Everybody was questioning every single stock that I was giving them. They thought that the fundamentals were weak. They thought that technically it didn't look good. Everybody had a lot of counter for every single recommendation that I gave. Because I have done my study and my analysis, I had high conviction and I had to tell them, listen, as long as you apply your stop loss, you don't have to worry. You're not going to be able to make money until and unless you take risk. So while any kind of overconfidence is obviously not appreciated there, having conviction is very important. And that conviction can only come from your objective analysis. The herd mentality problem, identify how do you identify herd mentality? If you have an opinion of the market or of a particular stock, ask yourself, where is this opinion coming from? Is it coming from objective analysis or from hearsay? If it's coming from hearsay, either do your own analysis if you have the time, skill, and knowledge, or get associated with a research analyst who's going to help you. Make sure that the research analyst has the required experience, has the required credentials, and is registered with SEBI. That is, they have the right license to give you the advice that you're seeking. So, how do you find such an analyst? There are many ways to go about it. You can either go directly on SEBI's website and look for research analysts, but that's a lot more complicated and very raw method of doing it. A more sophisticated method of finding SEBI registered qualified research analyst would be to go on GapUp. So GapUp is a new platform introduced by Economic Times and Rigi. It's actually introduced by Rigi and Money Control and Economic Times both have a tie-up. So you can simply search Gap Up, or if you're watching this on Economic Times, right above this view window, you will see there's a bar which says Gap Up. You can go there and you can connect with research analysts. Even I am there on Gap Up. You can search my name, or I'm going to drop that link in the comment section below for you to find me easily on Gap Up. And you can associate with research analysts. Now, of course, before you make any sort of payment, you want to know what work they are doing, what's their analysis methodologies. There is a lot of information related to that. Or you can also go to individual websites of the analysts on the platform itself. So I personally have my own Telegram channel through which I give a lot of information about my way of working and links to my website. So I'm dropping the link to my Telegram channel as well if you wish to connect with me to discuss things further. So coming back, herd mentality can be dealt with analysis, objective analysis, or expert advice. The third bias is confirmation bias. So the confirmation bias is a little bit more delicate in nature in the sense that it's it takes a lot of introspection and a lot of hindsight analysis to identify that you're suffering from confirmation bias. So, for example, take the Adani stocks. A lot of confirmation bias was circulating in the market when the Rebel report came out on it. So, how are people seeking confirmation? There was a lot of deniability. There was also some level of delusion there. But people were constantly talking about the contributions made to the country, the jobs created, and overlooking what was clearly out there present in very factual terms. So I personally, as soon as that report came, even though I was invested in the Adani group, the moment the report came, I was out of all my holdings. And I advised the same to all my members. Then, of course, I got this advice from someone who had a lot more maturity than I did. But the moment I saw light, I acted on it. Many people did it. That is confirmation bias. Basically, you have a tendency to believe something irrespective of factual information, and you consciously seek out information that supports your viewpoint. So, I'll give you an example of confirmation bias. Suppose you want to go long in a stock ABC and you have four friends. Out of these four friends, two are bullish, two are bearish. One is bullish short term but bearish long term. Other is bullish short term, long term but bearish short term. And same for the bearish one, vice versa. Out of these four friends, you will only listen to the friend who is matching your viewpoint in your time horizon. So if you are bullish on a stock for the short term, you will only listen to the friend who is bullish for on the stock for the short term, and you will ignore all the other three. And you will also take into viewpoint the person who is bullish for the long term while ignoring that they're not bullish on the same stock in the short term. You will only listen to the bullish on the long term part. So basically, given the whole pool of information, you're nitpicking on information which aligns with your viewpoint and disregarding information which does not align with your viewpoint. This is very common in, I would say, naive and immature traders. So the best way to deal with this is and give others a chance to keep their viewpoints, honestly listen to it, consider it before rejecting it. So, like I said, confirmation bias is a little bit more delicate in terms of identification and management. So, everybody will need to do their own level of certain level of introspection to identify their best way of dealing with a confirmation bias. Now, let's talk about the emotional aspect of investing and trading. So, when it comes to the emotional aspect, there are a lot of emotions which impact us. The two most extreme ones are fear and greed, obviously, which we have touched upon. But there are other emotions which do affect trading that I would like to talk about. One of them is hope. I find surprising how much hope people bring to the market. If you've bought a stock and if it's gone below your supposed stop loss level, please don't keep holding on to it in the hopes that it will recover, because that hope is not going to make any money for you. Objective analysis is going to. What you need to do is you need to package that hope and you need to put it away in a drawer and come with nothing but objectivity to the market. You need to know your stop losses, you need to know your target. I know there is a lot of regret also when the stop loss gets triggered and the stock goes up. But you need to understand that the biases kick in when that happens. We tend to think that every time we set a stop loss, it gets triggered and the stock market goes up. But there are two things happening here. Number one, your memory is partial. It does not happen every single time. It happens maybe 2 in 5 times. And number two, you are probably overlooking the need for improvement there. If every time you set a stop loss that gets triggered and the stock price goes up, it simply means that you've been setting wrong stop losses. Your stop losses have been too tight. So your focus should not be on working around stop losses. Your focus should be on setting better stop losses. How do you do this? You do this by doing something called trade journaling or using a trade tracker. Now, for instance, in my Trade Together program now, because I am encouraging swing trading as a side business to my members, or rather proposing, I give them a customized trade tracker in which they are directed to input their purchase date, purchased quantity, stock, cost, and when they get out of the position, their sale price and sale date. In addition to this 6 columns which they are required to input in, there are around 10 other columns which give them analysis on what they have inputted, not just the profit and the loss, but what their allocation was. How much was recommended and how much did they actually allocate? There is a note section. There are revised trailing stop losses which they get. There is a field that they have to mark to acknowledge whether or not they have set their stop loss according to what has been updated. So in build, so when you maintain a trade tracker, you automatically maintain discipline. And the fact is that this entire process of maintaining and having a trade tracker is not easy. It takes a lot of practice, it takes a lot of habit building. The most important thing that the trade tracker will do is it will help you understand your emotional influences and control them. All right. So, with that, I've come to an end of what I wanted to discuss today in the basics of behavioral finance. But I'm going to take 10 minutes and talk to you about your Q&As. So, if you have questions about the topic of behavioral finance or what we've discussed, feel free to ask them. I'll prioritize those questions. So, if you are on Telegram right now, you can just type trade with Kavita and press enter. The Telegram channel will open automatically and join it. Somnath has some way, I'm guessing he's asking for the limited analysis, monthly time frame, basically. I am also seeing some turnaround happening in multimedia stocks these days. So there is a chance that we might take over, but let's quickly do an analysis of the chart. I do see some sort of volume pickup happening. What is more encouraging than this kind of dry volume pickup is this decline in volume when the price started to go down. And the fact that now that the price is starting to pick up, we see return in volume. So this is the weekly time frame. So the volume trend is a lot more clearer on the daily time frame, which is very encouraging. Another very encouraging thing is that there's clearly a RSI positive range shift here, even though see, I'll show you one thing. Here you can clearly see that the price of Z has been between the level of 30 minus and 60. Here it tried to come up a little bit. So it is this part where it is taking strong resistance from the 200 EMA and the 500 EMA of the weekly time frame. Now, here again it took resistance and price wise it's almost at the same level, but look at the RSI. Look at the gain in momentum. And also when the price came back down here to take support at the 500 EMA and 200 EMA of the daily time frames, the RSI has continued to stay above the level of 40 and the volume is picking up, especially on the upside. So what I'm seeing is that for a long term, Z Limited looks quite attractive at this point of time. Your risk to reward ratio is especially very attractive because you need to maintain a stop loss at 235, basically just below the crossover of the 200 EMA and the 500 EMA, leaving some buffer. So 235 is your stop loss. Current market price is 256 approximately. So that is a stop loss of approximately 7.5%. And on the upside, I would keep a minimum upside of 650. So V Limited is one very attractive stock. ICICI Bank. Piyush wants to know if ICICI Bank is a good time to buy it now. The time right now is no longer to make fresh positions. It is to start revising your position. If you are somebody who did not buy when the market was down, that is before today's massive gap up opening, then wait for the market to cool down a little bit. Yeah. See, this is clear new trend because look at the volumes and we've just completed a pretty big correction of 11% in a matter of 3 months, right? 3 महीने लगे करेक्शन को और 11% ऊपर जाने को सिर्फ 41 days. Incredible. So I think that this rally is going to continue for a while longer. And personally, my target is 1071. But naturally, it's not going to happen in a straight line from here. What I would recommend is that if you want to buy not more than 25% of your position and then wait for the market to cool down a little bit and then add on to your position. So, with that, I've come to an end. We've come to the end of today's session. Thank you so much for joining in, and I will see you again on Wednesday in the Let's Get Technical series, where I bring to you one great swing trade from the past and we do a full dissect of it to see. We dissect it completely to see what we did right, how we did right, what we could have done better, so that we can draw out lessons and apply them in the trades to come in the future. Until then, thank you so much for joining and giving me your time. Namaste.